Good afternoon, everyone, and welcome back to another edition of Retirement Insight. I'm John Watson with Cap South. Joining me today is Lewis Robinson, Managing Director and Senior Wealth Advisor of Cap South, McDonough, Georgia. Lewis, it's always good to see you.
Good to be with you, John.
Today, you are talking about a subject that we all need to know more about, qualified charitable distributions. Tell us a little bit more about that.
Well, this is something I've been working with for several years now, and they go back to 2006 when it was first authorized, and it was extended every year for several years until 2015 when it was made permanent. But it's basically a way of making charitable distributions where you get more tax advantage from it.
I know you have been a certified public accountant for 30, 40 years. You've been a wealth advisor for well over a decade. The United States is always assessed as being one of the most generous nations in the world. And yet, given our tax code, we probably give those monies away as inefficiently as anyone in the world, don't we?
Yes, and a lot of that happened in the last few years, 2017 actually, because at that time most people itemized or a good portion of it, but the standard deduction was changed. And after that, a lot of people are using the standard deduction every year. And if you use the standard deduction every year, bottom line, you're not getting a big benefit for your contributions. And until 2020, we're not getting any benefit at all. So that's made a material change. And going forward, the need to understand how the standard deduction works and the itemized works, because it's important for as your calculation of your tax. Here's a tax return here. If you see line 11, that's your adjusted gross income. That's all your income from all your different sources you add up. The total goes there. And if you look at 12A, you have a choice to take the standard deduction or itemized deduction. Generally, you're always going to take the larger of the two. There may be exceptions where you don't do that, but generally you're going to take the larger of the two. And if the standard is larger, that's what you're going to take probably, and it will reduce your taxable income. Now, line 12B, you see charitable contributions. I want you to understand that is something new. It occurred in 20 and 21. My understanding it'll go away in 2022. But that was put in primarily because most people were not itemizing, and this was a way to reduce your taxable income without itemizing. The limit was $300 in 20, and then in 2021 is $300 for each taxpayer, or a total of $600 for a couple. As I said, my understanding for 2022, this is going to go away. And you subtract these numbers, your standard or itemized, and that donation, if you happen to use that, and that's where you calculate your taxable income.
But that 300 and 600, that is available for this year's tax return, right?
Yeah, for 2021, not 2022.
Got it.
And I just want to cover, what are the itemized deductions? Well, your medical expenses, but it has to exceed 7.5% of your adjusted gross income before you can take any of it. Taxes, that's your state income tax, property tax, and so forth. Under current law, that's limited to $10,000 per tax return. So regardless of what income tax or property tax you pay, the most you can deduct currently is $10,000. Interest expense generally is on your home mortgage. For retirees, the home is either paid for or the mortgage is greatly reduced, so there's not a lot of mortgage interest left. And the last one is charitable donations. Well, if you don't have a lot of interest expense and a lot of taxes or medical, then charitable donations are going to be the one where you get your deduction for. But because the standard deduction is so high, you've got to have a lot of charitable donations before you get any benefit whatsoever. And here's the illustration of why this occurred. In 2017, The standard deduction for a married filing joint was $15,200. Let's focus on the right side, which is for the married filing joint. Well, for 2022, that number has gone up to $28,700. So thinking back to the itemized deductions that I mentioned a while ago, you've got to have a lot of itemized deductions to tally up to $28,700. Unless you have a lot of mortgage interest and at least $10,000 in taxes, you're probably not going to be able to itemize unless you give a lot away to charity. Then you're going to lose the benefit of the $28,700 because that's given to you. So that's the reason charitable planning has changed so much. And this is when you need to use your qualified charitable distributions. Is when you're in a position where you make charitable donations. I didn't say make a lot, but make charitable donations and you should use them. It applies to if you answer yes to the following 3 questions. So I'm going to ask you these questions. First of all, do you make charitable donations? That's of any amount, 200, 300, or 500. And do you have an IRA, or do you have a retirement account that can be converted to an IRA, like a 401k, a 457b? Most of those can be converted to an IRA, so you can use it for your donation. And you have to be 70 and a half years of age. Now, it's not the year you become 70 and a half, it is when you're 70 and a half. This used to tie in when you had to make your required minimum distributions, but it does not anymore. They're separate. So the qualified charitable distributions start at age 70 and a half years of age, the day after. If you answered yes to these questions, you should be making charitable donations from your IRA. I don't know any reason, I can't think of any reason you would not do it, because you're going to get a tax benefit indirectly or directly by doing that. And now, what is a qualified charitable distribution? It's basically a charitable donation, a rollover from an IRA that is non-taxable. It's going to go directly to a public charity, a church, or a qualified public charity. And it has to go directly from the administrator of an IRA to the qualified public charity, whereas it can't go to the taxpayer, then to the charity. And also, if you're required to take required minimum distributions, then you can use those. For instance, if your required minimum distribution is $15,000, you could give all of it to charity and not pay tax on any of it, or you could give any portion of it to charity and pay tax only on the part that you keep. So the RMDs can be used for qualified charitable distributions.
I've learned so much from listening to you teach on this, Louis. I think my initial impression was that, well, this might help me a little bit with my tax return, but these QCDs have long-ranging impact across your whole financial plan, don't they?
Yes. First of all, the simple thing, it'll just reduce your income tax, federal income tax. And most retirees don't pay much Georgia tax, so it probably won't have a lot of, or maybe no impact on Georgia, but it will reduce your federal income tax. And it could reduce the taxability of your Social Security benefit, meaning your Social Security is taxable. The more you make, the more of it is taxable, the higher the percentage of it is taxable. So in a lot of cases, it will reduce the Social Security amount that's taxable to you. It could reduce the capital gains tax rate. Believe it or not, there is a zero capital gains tax rate. And by not having this RMD, having to increase your income, it could reduce your income enough that that you got a zero capital gains. Your Medicare premiums is based on your adjusted gross income. If you can reduce the amount of your required minimum distributions for you that is going and make those to a charity, it could reduce those Medicare premiums. And if you're making distributions before you're required to, or you're making distributions in excess of the required minimum distribution, The effect of that is going to reduce the required minimum distributions in future years. So, and if that happens, that's going to reduce your taxable income in those other years because you're having to take out less. And if your QCDs exceed your RMDs, you can make a larger Roth conversion in the other years. And the reason is because you'll be in a lower bracket if you've reduced the RMDs for those future years. One of the things, it's a technicality, but the qualified charitable distributions, they are limited to $100,000 per individual per year. So a couple could actually give $100,000 from their each IRA to qualified charitable donations and would not have to pay any tax on that whatsoever. And here's an example of where a client contributes $3,000 per year to their church, and they're in the 12% tax bracket. Now, this is an actual example from a client. It's not something I made up. So this $3,000, that's what they normally give. Their tax savings is $666. So it's actually 22.2%, not 12%. And the reason is because of the calculation of Social Security, the way that impacted it. I just want to go through the gifting process, make sure you understand it. You're going to give $3,000 to your charity, your church, or whoever. You don't want to do what this illustration is showing, which is you take your distribution payable to you, go to your checking account, then you turn around and write a check to the charity. You don't want to do that, because if you do that in this illustration I show you, you're going to owe $666 in taxes that you wouldn't owe if you did it this way. You want your distributions to go directly from your IRA custodian to the charity. Then you'll have a tax savings of $666. Here's an illustration. This is something that I like, but I find most of my clients and people I deal with don't like to see charts like this, but I think you really need to see this to understand what's going on. If you look at the second column, where you got taxable income of $29,445, and you compare that to the first column, you'll see that they had an IRA distribution, and this happens to be a required minimum distribution of $15,909. They had a pension of $20,903. They received a total gross amount in Social Security of $41,354. That's the total amount they've received that's subject to tax. But because of the calculation you go through, only $18,967 of that is taxable. So then you reduce that total number by your standard deduction and by the $300 for the miscellaneous gifts to charity, and you have a taxable income of $29,445. Well, under the QCD column, all you do is have that $3,000 go directly to your charity rather than putting it in your checking account and writing it to the charity. The effect of that, it reduces your taxable income, and it reduces it more than $3,000, because now instead of having taxable income of $18,967 on the Social Security, you only have taxable income of $16,417. So by having this QCD go directly to your charity, you've reduced your taxable income by $5,550, not by the $3,000 that went to the QCD. The effect of that, then you have taxable income $23,895. So instead of owing $3,016 in taxes, you owe $2,350. That is $666 in your pocket that you won't lose to inflation or rate of return. That's money you save that year. You can do whatever you want to with. That is a 22.2% rather than the 12% tax bracket you're in. I don't know why you wouldn't want to do this.
I think it's amazing. We saved $700 just from changing the name on the signature of our check. Instead of us, someone else, and it puts $700 in our pocket. It really is amazing. Louis, we have just a few questions in the time we have left. I make political contributions. Do those qualify under this as a QCD?
No, they do not.
And in the past, I have made contributions to my former university. Do those qualify as QCDs?
They generally always do. The only thing you have to be concerned if you're getting football tickets, then you can lose it. But if you're not getting football tickets, they would qualify.
And that would be any tickets or any benefit parking or any of that, wouldn't that impact it as well?
Yeah. Bottom line on charitable donations, you can't get any benefit out of it. It's a gift to whoever you're giving it to. And
okay. I am confused as to the ages for RMD and QCD. Could you take a moment and explain those?
Yeah, well, I'm glad you asked that question, because it used to be 70.5, and they increased it to 72. But by the way the law was written, that did not change the rules for the qualified charitable distributions. They stayed at 70.5. But the RMDs are calculated the year you become 72. And you have to take it out by April 1st of the following year. I generally always recommend you take it out the year you become 72, because if you don't, the following year, you'll have to take it out for that year and the prior year too. So generally, it's the year you become 72, you want to take it out. And one of the reasons why I'm glad you asked this question, John, is that just this morning, I've read that Congress has passed a bill, the Secure Act bill, amendment to it, not amendment, but a new one. And if it goes through the Senate like it is, it's going to increase the required minimum distribution age to 73. I think that would take effect in 23, eventually over several years. And I think it's maybe up to 2030. The required minimum distribution could go up as high as 75.
Okay.
The way you calculate the RMD just lets you know, you take the balance in your plan, your retirement account, IRA, or whatever it is at the end of the year, and divide it by that number, which is your life expectancy. And that's what you have to take out for the next year. And the life expectancy of a 72-year-old is 27.4.
Okay. I know everyone listening is wondering, okay, now that it's been explained to me and I see the benefit of it, how do I go about taking advantage of this? And I really appreciate you agreeing to do a second session on really getting into how to set up a QCD and how to take advantage of those monies. If you have questions for Louis, please call the number on your screen, 678-695-6355, or you can reach him by email at lrobinson@capsouthpartners.com. I'm John Watson, and on behalf of Louis Robinson, we thank you for joining us today, and we look forward to seeing you back for session 2 of Qualified Charitable Distributions. Take good care.
Thank you.